Hey guys, Tara Ryan here, and today's tip from Tara is geeking out on behind the scenes data and how conventional loans actually get priced. I had a client right now, and he's under contract doing 5% down because he's going to sell a home later, use those funds, and then recast. We use that strategy all the time, by the way. But he started thinking about it, and he's like, I do have these other assets. And he came to my team and he said, hey, I'd really like to go ahead and do a bigger down payment. I think he had like 17% down. Here's the thing, you would think that a bigger down payment would mean better terms for the loan, right? Meaning, uh, most people think that the bigger the down payment, the better your interest rate will be. It actually doesn't work that way. And so I thought I would show you guys some of the behind the scenes things that impact loan pricing on conventional loans. Again, nothing for you to memorize or know, but just to have some concepts of the things that we lenders are dealing with. So what are we looking at here on the screen? This is called the LLPA matrix. So it's loan level pricing adjustments. And one of the biggest factors here on the left is the credit score. So across the top is the loan to value. So the bigger the loan to value, the smaller the down payment. And then you have this matrix. All of these numbers here are adjusters. Think of those as negative items, okay? There are extra costs that are imposed on the loan, which Fannie Mae would say is to adjust for the increased risk of that transaction. I don't necessarily agree, but that is how they would describe it. Now, this is not in addition to the interest rate. This is to the price of the loan. Think of it like what you would pay in points to get that rate. So typically it's about 0.375 that you pay in points to get 0.125 on the rate. So when you see this adjuster here, this 0.375 hit to the rate or this pricing adjuster, that basically means you're paying an eighth higher in rate, or you could pay the 0.375 in points. Okay, just to give you an idea. So bigger numbers are here are worse for rates. I'll get down to these features below in a second, but let's just look at this matrix and see what we can learn. So zeros would mean the best possible rates because there's no negative adjusters. There's no increases to the pricing. So the very, very best rates then are for over 780 credit score. This is ridiculous, guys. Everybody, I mean, really, 720 to 800, it's all about the same. These are folks with no blemishes in their credit, but through minute differences of what your balance might be on that day compared to your credit card, you could find yourself in a different bucket. I think it's ridiculous, but in the last couple of years, they added all these additional buckets. So for the very top is 780 and above. And 25% down payment, so a 75% LTV or less. At 20% down, even at a 780 credit score, you're not getting the absolute best interest rate in the market. Is that interesting? I find it fascinating. Okay, so here's something else that I find interesting in my mortgage geekdom. If you do a smaller down payment, what happens? The pricing gets better. That's less of a negative adjustment. Okay. And in fact, if you only do 3% down, you're doing better than somebody doing 20% down. What? That's just the way it works, guys. So for my client who was doing 5% down, and then he wanted to do 17% down, that actually pushed him, in his case, where was he? He was in this bucket. Went from here to here, which means he had to add 0.375 in points in order to keep his same interest rate. Completely counterintuitive. And again, everybody just thinks more down payment is better. Why is this happening? A couple of things. They realized in recent years that loans with mortgage insurance actually perform better. And what I mean by that is, in the worst case of a default, the ultimate investor ends up with more money if the loan had mortgage insurance on it than if there was no mortgage insurance and they foreclosed and had that equity in the home. The ability to use mortgage insurance to reimburse the lender makes that loans with smaller down payment actually less risky for the lenders. Okay, what are some other key things that might be interesting here? Let's see, if you have lower credit scores, but you're doing at least 40% down, if you're at least in this column, look at all these zeros here. Okay, so if you're in that range, you don't have any of these negative adjusters. And so you're going to get the best conventional interest rates um, if you have a big down payment, regardless of credit score. Some other things of interest, there are adjustments for condos. You see that here. If you're not doing at least 25% down, you're going to pay a higher rate for a condo than you would for a non-condo. And of course, investment property and second homes. Now, these used to be very different. They're now the same. So when you buy a second home, it's treated just as kind of negatively as an investment property. And the last thing I'll leave you with is that this is for loans greater than 15 years. If you're doing a 15-year mortgage, conventional, none of these negative adjusters apply. So, regardless of credit score, regardless of loan to value, you're getting the the top interest rates. They just don't put any of these negative adjusters on there for a 15-year mortgage. A lot of mortgage geeked out detail. Why am I sharing it with you? Because things are weird in mortgage guideline world and we are here to help. So if you ever have questions or need anything at all, me and my team would like to help you.